Great, thank you. Thank you again to our panelists for joining us, and thank you to all of you who are in the audience. We welcome you again to our spring membership meeting. Many of the topics that have been covered this morning, we will try not to replicate in this panel, although you will continue to see some themes throughout the day. But here we are, so we're 10 years post-crisis. A lot has changed, obviously, with regards to regulatory reform, but as you heard Deputy Prime Minister also mention this morning, we hope that a lot of that is behind us, a lot of it is finalized, and let's really start to look towards long-term sustainability issues in the industry and beyond. We're in a world of unprecedented technological change that's really impacting our industry, whether that's banking, asset management, insurance, and hopefully we can talk about a lot of that going forward. And one of the questions that I think we'll hope to address also is, why does this matter? Why does it matter for the economy? Why does it matter for one of the G20 priorities of sustainable growth? And why does it matter for financial stability? So, as we mentioned, we've got a great cross-section of panelists here with different backgrounds from different geographies. So really excited to share all of that with you today. So John, I'm going to start with you. So you have a unique perspective given the various roles you've had. You were comptroller of the currency in the US, and now you're the chairman of Citi. So when you look at regulatory environments globally becoming increasingly complex, costs of compliance continuing to grow, how are you effectively navigating these challenges while also adapting your business model to look towards sustainable earnings?
Well, thank you, Lauren. Well, it's a good question because we are 10 years past the crisis, and yet I think if you polled the biggest institutions, you would find that they're still spending an enormous amount of time and resources on regulatory-related costs. I think there is some good news in this, and that is that there were some huge, what I would call existential regulatory requirements that were adopted in the crisis, like for the US firms, CCAR stress testing, resolution planning, in particular, things that there just wasn't an option to fail either of those tests. It was an incredible amount of money and time and resources to deal with that in its earliest iterations because the consequences of failure were so pronounced. But my point is, we're now 10 years into it. I think firms have gotten better at dealing with it. It's still a big chewing up of resources, but it's less than it once was. I won't quite call it business as usual, but it's part of the cadence and rhythm each year, and I think the amount of costs has gone down to a certain extent. A lot of fewer use of consultants, more stuff coming inside, so I think that's a good thing. And I think even things like complex systems like the Volcker Rule have gotten easier to manage, even though it's a constant resource. So that's point one. Point two, I would say on the BSA AML side, however, firms are still spending an inordinate amount of money, or I shouldn't say inordinate, just an incredible amount of money, and I don't see that changing much over the future. It's just such a political and policy imperative for governments and policymakers around the world. It's hard to do. We may find a day when RegTech and other system developments can reduce the cost of that materially, but right now it's just going to cost a lot of money. In terms of navigating it on a go-forward basis, I think regulators have moved away from a world in which they've been really concerned about core safety and soundness issue. How much capital do you have? How much liquidity you have? And much more, as you suggest, to broader compliance issues around internal controls. And I think all the firms are feeling that from a systems perspective and the like. And if you ask me, how do we navigate our way through that? Well, I would say the biggest single thing, there's two parts, and Douglas, will appreciate this, is try to avoid getting into trouble and getting a consent order. Because when you do, it costs a fortune. It doesn't matter what it is. So you have to develop both a cultural question to develop the kinds of standards at the firm that you're dealing with where they don't get into the kinds of trouble that requires this. But even on a more general compliance basis, you have to spend the money up front to stay on top of things, because if things go south, it will cost much more in the end. So and then the last thing I would say, it is causing a change in business mixes. I mean, I think, for example, it is harder to engage in consumer businesses outside of your own country because of the heavy BSA AML component to it. And I think it has caused firms like ours to back off, and not by itself, there are other factors involved as well, to back off from some of those businesses and focus on ones that have lower compliance burdens and compliance costs. And that's just a fact of life that you have to take into account as you go forward.
One of the questions that was asked by an audience member in one of the previous panels was specifically with regards to the US and a sense of deregulation versus just a tone and posture. Do you have, I'm going to front run the audience on that since it was obviously something people were interested in, but do you have a sense of, is it one of those or the other?
John Waldron answered this question. I largely agree with what he said. Well, first of all, I do think there was a significant change in that. There was a lot of momentum to keep going with more and more regulation. I think that's stopped. So there is an absence of piling additional stuff on, number one. Number two, there has been some modest regulatory relief for smaller institutions. But for the largest global systemically important banks, it's, from a policy perspective, really not much, honestly. There is talk of doing some more, and that may happen over time. But just from a legislative perspective, I just don't think much is going to happen. And on the really big things, it's just a slower environment to get to that place. So I think it's been quite exaggerated in the press. This rolling back of American regulation is just not so. But it is true, it's not adding on at the pace that it was before this administration.
Douglas, you obviously have various different backgrounds to weigh in on this conversation, having been at HSBC. Now you're hypothetically an investor in a lot of these large financial institutions. How do you see this evolution, and again, kind of how do we find sustainable and profitable growth for these organizations?
Well, I think all elements of the financial industry are challenged, and one of the responses to that challenge is to focus very much on simplification and business model. I mean, I think in the aftermath of the crisis, the primary concern, as John said, was around capital and around removing some of the more egregious leverage products that existed. I think there's a much more intelligent reflection now, both with regulators and with the institutions themselves, in terms of how do we simplify to reduce cost and complexity, and how do we truly understand the business model that we have, and how do we make money from that model. And I think you've seen all of the major banks in the world simplify, get back to core.
Yep.
I think they've taken away products that were marginal, because the cost of being in smaller countries where, as John says, AML kind of costs and complexities just simply couldn't be justified by the revenue stream. I think a second thing, which I think we're in the early stages of, and we'd like to see more of, is cooperation within the industry. I mean, technology is going to be part of that. I mean, blockchain will be interesting, I think, for supply chain management. And again, you see consortia existing now in many aspects of technology development, because there's no point in having 7 or 8 solutions. You want interoperability, you want scale. I think the same's true, even more so in AML, BSA. It makes no sense for all the firms to invest heavily and then protect what they've done from each other and pass the bad guys around. You want people to cooperate so the bad guys leave the system altogether, and that means changing the rules to allow data exchange between institutions, cross-border, and even more importantly, between public and private sides.
Particularly the last, I would say.
Because the law enforcement guys know who the bad guys are often long before the banks do. And indeed, there was a clearinghouse report written just before I retired from HSBC, which I thought was kind of interesting, and in a kind of a gentle way, it sort of said the money center banks in America were spending $8 billion in BSA, AML, which was roughly the budget of the FBI. And was it possible if the FBI's budget was doubled it would have more impact than filing the SARs that hadn't led to any increase in prosecution. And it was a kind of a neat way of saying, if we're going to spend this money, are we getting value for it? And I don't think the industry's pushing back in that. I think the final thing is technology. We'll get onto that later. But we need to use technology more intelligently and recognize that we have a huge amount of data and how we're going to use that data with technology to get a more profitable business model.
That's great. Thank you. I want to come back to some of the data issues and technology, obviously. Mr. Chu, you're sitting in a unique position coming from China. Also in one of the previous panels, they talked about kind of the opening of China, and how we would all really be interested in your thoughts on that and where we've come over the last 10 years, but kind of what else is necessary and what are the challenges?
Sure. At the onset of the financial crisis, and each country and region obviously respond differently and recovered differently. China at the time responded with launch of very large infrastructure investment. At the time, the number circulated is 4 trillion Chinese yuan, but actual number is higher. In 2008, for example, the total amount of financing in China is 7 trillion Chinese yuan, but 2009, it doubled to 14. So there is an increase of 7 trillion Chinese yuan. That's close to $1 trillion US. So obviously this stabilized the situation, helped the China economy continue to grow. And but the issue is the bank did the heavy listing. Last year, for example, the total amount of financing in China is 19 trillion Chinese yuan. But when you look at the structure, 81% of bank loans, only 13% are bond-related capital market activities, and only 2% are equity financing. So the issue has been, since the financial crisis, the way Chinese responded, you have this very heavy-handed bank-centric system which largely respond to government directives for investment, which lead to many issues. Obviously led to overcapacity in many industries, from steel, cement, glass, all kinds of building materials, but also solar panels, shipbuilding, all of that. And other problems, and this lead to pollution and debt burden and high leverage and risk. So so the system is you gotta reverse or actually change direction. Another drawback for the bank-centric system is the savings people just put in the bank's deposit and earn very low interest, and those deposits can easily get enticed into high-yield online P2P platforms, which many of them turned out to be Ponzi games and produce a lot of social activity. I think the things with China is China's economy, 90 trillion Chinese yuan, saving rate is extremely high, in the 40s. So you have 30, 40 trillion savings that can invest in China. So if you channel these savings, China can grow at very high speed for a long period of time. There's no issue. The problem is the structure. Chinese system need a long-term capital. As China is changing, focusing is change from a speed to quality. China need more PE, VC, and equity capital formation. I think the key is for regulations. The key is for investment banks and securities firms to step up the plate and convert all these savings into long-term capital.
And how do you see that playing out over the next 5 to 10 years? What are the challenges? Who are the important players in that?
Yeah, the key, I guess, is really to make the capital market work, right? For this long-term capital to channel into the right areas in the economy. China has the world's second largest stock market, but it's not working. When you look at the economy over the last 10 years, more than doubled, but the stock index, if you look today, is almost at exactly the same level as 10 years ago. And sure, you have some stocks that increased tenfold, but overall, the stock index level is about the same. There are obviously many issues, and certainly, you want regulations to be more market friendly. Certainly, you want the listed companies to be of good quality and good corporate governance. But I think one of the key area is long-term capital. China's stock market is now mostly by retail investors. 80% of volume is traded by retail investors. Short-term trading. When they see opportunity in the stock market, they will just get their deposit money to come into the stock market. So it's quite volatile. I think the key is to create long-term capital. Two things is happening, I think. One is this year, China changed the income tax scheme so that tax deduction and tax exemption is allowed. China is working on IRAs, quite similar to U.S. IRA, where you can put tax deductible contribution into account that locked away for a long time, but can invest in mutual funds, equity funds, stuff like that. I think that we looked at it, with corporate pension and professional pension together with IRA. Over the next 10 years, China can have 20, 30 trillion Chinese yuan saving, converting to long-term capital. Another area is international money. International ownership of Chinese stock market is about, in terms of market cap, it's only 2%. When you look at Korea, when you look at Taiwan, that's 20s. So, as MSCI is gradually increasing the weight of its benchmark emerging market index for China, and China's regulations is becoming more friendly to international capitals, we felt there could be 10 to 15 trillion Chinese yuan in 10 years to come to the capital. So long-term capital is important to make it work. But also, another significant thing that is happening this year is the launch of Shanghai Tech Board that's about to happen. This is a Chinese version of NASDAQ to make it easier for Chinese tech companies to raise capital. And this is an information disclosure-based registration system as opposed to government approval, and also IPO price control is going to eliminate. So I think China is laying a foundation for these longer-term systematic approach. I think China probably will not repeat what happened in the last 10 years. The stock market isn't even performing.
Great, thank you. I'm going to pivot a little bit to obviously a lot of the technological developments, disruptors, and we can come back to China on that topic because obviously all eyes are on China in many ways in that regard. But John, when you think about city strategy and how you're employing a lot of these various technological developments, are there examples, and how are you thinking about the disruptors? I know your shareholders letter mentioned some of that recently, but so how are you viewing that?
Well, it's like all the major firms, and it's not true just in finance, but everywhere. We're all dealing with technology and putting heavy amounts of investment in the technological space. I would say it's about 20% of the expense base for Citi, which is a big number. And we do it in different ways. I would say there's sort of the innovative way that we sponsor and have innovation labs that we've established in various centers around the world, in Israel, in Singapore, in Dublin, and in the United States. And these are places where we work with different technologies and see how they might work, experiment with things. And at the same time, we have something called Citi Ventures, which makes substantial investments in various kinds of startup companies, fintech companies, decides about partnering with different companies. And all of that results in technology that some of which ends up being in part of the Citi offerings. And so that's one general way we go at it, but more specifically, you will see things on the institutional side. Citi has long been known for its international payments system through its treasury and trade solutions business, very technologically heavy business. It's incredibly important in that business to invest in ways to make the products and offerings simpler, easier to use, more client-friendly, and we spend a great deal of time doing that because, as Mike Corbett likes to say, now it's not good enough to be best in class on any particular product among the financial institutions you deal with. People are now used to, customers are used to, clients are used to the simplicity and ease of use that you get with all sorts of general software and technological products. And we have to meet that standard every day. And so that's a big focus on our payment side in the wholesale space. On the consumer side, we've gone very heavily into the mobile space. We've been actually, the most innovative stuff has started here in Asia, where we have a big consumer presence, and there are many things going on in the Asian markets that have been slower to have been adapted in the West. And we've taken that learning and used it in the United States and in Mexico, for example. So just to give you a couple of examples. In Mexico, we own one of the biggest banks, Citibanamex there, big player in that market. But Mexico, for such a fast-growing, emerging market, it has a very high percentage of people who are not banked or underbanked. And yet those same people have a big penetration of mobile phones. And at the same time, the government is quite interested in moving people to an electronic payment system because the heavy use of cash is more conducive to corruption. And so the banks, Citi among them, have worked very closely with the government, including the new government, to roll out a new technological payment systems that use QR codes for payments. Very simple product, very simple account, and the thought is over time it will allow penetration and new banking customers for Citi, which we think will be really important. In the United States, it's much more a story about cards and the big data that we have on individuals and cards, and we have a very branch light strategy there, but it's very much developed to ease of use, the mobile phone working better, and taking advantage of our position as having the largest card platform in the world, and using the technology of that to grow other parts of our business.
Do you think when you look at, so Citi Ventures is a great example where you've gone out and invested in companies that you want to partner with. And when you think about the tone of the conversation between whether it's the fintechs or the big techs and the industry, do you think that's shifted over time? Are we in an environment now where people want to be more collaborative, or is it still very adversarial? You know, how are you approaching that?
I think the fintech companies, that piece of it, the small startup, that has changed. I think that they were perceiving themselves as much more direct competitors and disruptors to the financial institutions, and the financial institutions were looking at them in that way. And I think over time that's become much more of a collaborative partnership kind of enterprise. I do think there still is quite a bit of competitive tension with the big tech companies over how that's all going to work, and how who's going to get the access to the customer, who's going to own that relationship, and how much. Of course, there's always a big issue about regulation.
Right.
And the question is, do we move in a direction where banks that provide payments are less regulated to compete with other non-bank entrants coming in, or is it the other way around, where the non-banks have to be subjected to more bank-like regulation? And if so, does that create sort of natural barriers to entry that are more pronounced in the United States than they are in, say, China?
Right. Same risk, same regulation.
That's the idea.
Right. Douglas, how do you, now that you're in the asset management business, how do you see technology shifting the way that you're doing business, interacting with your clients who still want a seamless client experience, whatever that happens to look like?
Well, clearly digital is going to be a huge part of it. I mean, I think one of the challenges to asset management over the last decade has been, as Martin said earlier, the inexorable shift towards passive as well as private markets. But the passive was obviously technology driven because it's effectively a technology product. I think that's forcing the active part of the industry to use technology much more intensely and much more intelligently to essentially transform from a product-led business to a solutions-led business, and effectively the personalization of product to institutional and wholesale clients, but also to the retail space in terms of being better able to categorize your clients because you know more about them, and technology enables you to use data to create a risk profile and then to personalize product by type or even by individual products for individual customers. And I think if we're going to compete in a space where to attract higher margins for what we do as against the passive, it's going to have to be more personalized, which is going to have to be technology led, otherwise it will be unaffordable. And I think that will be the trend in the industry, to move to what some people call bionic banking, part human, part machine, or smart beta, where effectively you're taking heavily quantitatively led strategies and adding a certain amount of overlay to them to produce an outcome for customers that they can understand how it's been constructed, and it's cheaper to deliver than a highly personalized service. That is the inevitable direction of travel.
And so, and this is part of the industry. We were talking in the speaker lounge earlier about kind of feeling wildly optimistic about certain things and sometimes also wildly pessimistic about others. I feel wildly optimistic about how we're going to change, this personalized aspect of it and using data and what that can mean for credit decisioning and financial inclusion. But there's obviously risks involved in that as well. And so when you think about a full-on personalization strategy, insurance would be a great example of where there's huge risks that come with that. So how are you addressing that, and controls that are in place and those types of things?
I think it's a huge challenge, because there are two aspects of the technology revolution that impacts consumers particularly that are contradictory. One is consumers want to be able to access services, including financial services, simpler, and at the same time they want protection from cyber threat, people pretending to be them and so on, or stealing money from them. And yet, if you ask them to have a 12-digit password and change it every fortnight, they get pretty disappointed with that, and they're not going to do it. So, that challenge in terms of collecting the amount of data, I think one of the advantages actually of cyber threat across the industry, including banking, is that as cyber threat becomes more conscious, people become more conscious, it's a very easy way to get people to give you the data you need to identify them more uniquely. And indeed, I think part of the future will have to rest upon individuals having a unique digital identity, like has happened in India. And indeed there being total transparency behind corporate and other trust vehicles as to who's behind them, so that we kind of know who's behind them and know more about the consumers to protect them from digital identity threat and so on. But that balance between making it easy for people to do what they want to do and protecting them from people who pretend to be offering them a service when they're trying to steal money, I think is going to be a challenge. And I think, for the banking industry, it's particularly interesting at the moment as to where the responsibility lies. If you've got an authorized instruction from a customer to move money, and then they come back and say, I shouldn't have moved money because the website I went to wasn't real and so on, can you get my money back? Well, the bank will try and get the money back, but is it responsible for responding to an authorized payment instruction? Some people say yes, in which case you get the moral hazard of people not taking care anymore because they're kind of underwritten by everyone else. Not a good outcome, and at the same time you want to protect people from the mistakes that they might make. So building that level of protection and ease of access, I think, is going to be one of the elements of data management, which is a huge issue for, I think we're going to be at the sharp end of how data is used in the debate between privacy and facility over the next 2 or 3 years.
I think that's a good pivot to China and technology, where you already mentioned kind of P2P and how that has evolved, and obviously a lot of eyes are watching Chinese big tech. Do you want to talk a little bit about what's happening there and kind of how you see that landscape?
Sure. Fintech companies in China is actually, in a sense, is very lucky. When the mobile technology, is widely available and, can be afforded by the masses, Chinese financial services system is still underdeveloped. For example, the credit card penetration is very low. And also, on the regulatory side, the regulators are very tight on traditional financial services, but they reasonably tolerate on the fringe activities that is outside their core focus. And also, China has a very large young population, and they are willing to try new things. And also, the cultural difference between China and other countries towards privacy, there's also a difference there. So given all these advantages, Chinese fintech companies, technology companies became extremely successful at creating new and novel financial services, disrupting traditional financial services. But this does not, this actually come at a cost as huge. There is huge cost to it, as I mentioned, a P2T platform. Billions of Chinese yuan disappeared into online P2P platforms that basically Ponzi games. But they're very successful. There are quite a few. I will mention 3 areas. The first areas, the giant technology company becomes hugely successful is the fundamental payment system and the mobile payment system. And now if you go to a typical Chinese restaurant, chances are the payment, more than 50% are paid by WeChat payment, and the other 45% by Alipay. Very small percentage of people are still paying credit card, debit card, or cash. So, in the beginning, all these payment mechanisms free to merchant. Now the fees are introduced, but very low, disrupting the bank's payment card payment revenue. And also, this ease of payment really changed people's consumption behavior. So online business of various kinds are really widely available. People just purchasing things just one fingerprint away from their cell phone. They easily, the online business is really prospering. The second area is that the Chinese fintech companies are extremely successful is cash management instruments. Because of the advantage in payment, for example, Alibaba's affiliate Ant Financial is now having the world's largest money market funds, 2.7 trillion Chinese yuan. That's more than 400 billion US dollars. And this 2.7 trillion money market funds, those are larger than some of the deposit at large banks in China, as you can imagine, their power. And another interesting thing is the amount of account that they have. When you take out the very young and very old population in China, they probably have 50% of the people have account with Ant Financial. They have 600 million accounts. And now they are into selling passive product. So we'll see how that played out. They're into, they have money market fund, now they're selling a passive product, index fund and stuff like that. The third area of success that they achieved is the online lending. When a person go online, as I mentioned, because of ease of payment, online activity market is very vibrant. And when a person go and purchase something, and because, for example, Ant Financial have all the data about your past purchase and your payment history, and they give you instant credit. For example, Ant Financial had lent out about 600 billion Chinese yuan of this kind of lending, and to 200 million people. So if it is a traditional bank, it would be the world's largest credit card issuer. And their portfolio, because we underwrote some of their ABS, we look at the risk. Their underwriting risk is quite nice, and default is in very low single digits. at least during the past economic situation. So they are, so in this regard, they are very successful. Sure, their success has been largely to C with simple and standard product. And, in financial services, we felt institution business and high-end may be different. But still, I think, the way it is going, I think it is clear that financial services, at the end of the day, you got to be focusing on access to clients' mobile device. And if you're not 3 or 4 click away from their mobile device, you're not going to be mainstream. You're not going to be in scale. But obviously, this doesn't mean traditional financial services couldn't do this. And in China, we do have financial institutions where they focusing on laser focus on a client's experience, and they are focusing on a data analytics driven business. They focus on innovative culture, quick response, and they're able to create all these mobile phone access to their financial services. They do extremely well. They certainly have their traditional financial expertise. They certainly have better risk management processes, and they are successful as well. But I think overall, China experience is this is, if you don't spend time, if you don't become successful in this market, you'll be put on a fringe.
And that dovetails with what John was speaking about in Mexico and mobile penetration also. So some commonalities there. So we've talked a little bit about data and some ways to use that going forward. Machine learning is a topic we talk about a lot. Cloud is a topic we talk about a lot. John, when you look at the products and services that have evolved at Citi over the last couple of years and what you're anticipating going forward, how does all of that play into what you're offering your clients now, and how has all of the digital services platform changed based on what's happening?
Well, it's, everybody's moving to the cloud on a lot of things. It's not necessarily the part that's as much client-facing. There are other technologies that are related to that. People are looking hard at blockchain, for example, and varying different use cases, and that's a big focus for some more than others. I think the cloud services and the artificial intelligence, a lot of that's been more going towards the back office and reducing the cost curve in the back office functions. And that's where you're likely to see more automation over time. As we've and others have talked about, that's really the place that you're likely to see the most reduction in jobs and cost savings, over time.
And there is a lot of talk of kind of the changing of the nature of the workforce, and part of that is that the automation component, but also looking for getting the right talent for all of these things. And do you struggle with that? And how do you approach that going forward?
Well, yeah, talent's always the critical thing, and I think the banking industry took a body blow during the financial crisis. Before that, used to be, top of mind for graduates from business schools and other places, and then it shifted to the tech world. I think some of that pendulum's coming back again. There's a lot of things going on that are useful. One thing I would like to mention that I think we see is really important, and this came up in one of the earlier panels, is gender equity. And Citi has been particularly forthcoming in the kind of disclosures that it has made, starting with, and a lot of this was prompted by shareholder proposals and the like, but nevertheless, and by requirements in the UK and elsewhere. It started with doing comparisons of whether there was equal pay for equal work between men and women and for other ethnic minorities, and that thankfully came out pretty well, very close, 99% things. But the part that people have been more reluctant to disclose is the median pay and the comparison of median pay, which we call the raw unadjusted pay gap between men and women. So in Citi, for example, half of our workforce is female.
Right.
Sounds great, but in terms of median pay, the median pay of women is only 70% of the median pay of men. And what that is really telling you is that you have much less representation at the more senior levels of the company. And we made a decision that it was important to start disclosing that, to adopt a status of radical transparency, because as you disclose it and measure it, you will more visibly take steps to reduce it. And to get back full circle to your question, we think over time that will be a comparative advantage, that people will view Citi as a great place for women who want to go work and advance in the workforce, that it's a receptive climate. And we're doing that not just with women, but with African Americans and others throughout the company. So that's a very important kind of human resources talented thing that's going on, apart from being the right thing to do.
We could have a whole panel on that, and we, in our annual meeting in the fall, are actually thinking about doing that as far as kind of the actual practical ways to go about doing that, because, you know, we've talked about it for a long time, but what actually are you doing in your workforce to encourage women to stay and to,
Yep.
you know, move up through the ranks? But so, Douglas, I want to ask you the question about kind of data and how it's changing your world. And you talked a lot about kind of financial crime also, which I think is something near and dear to your heart. But if you want to talk about that, or how else is kind of data changing the business model as you see it?
Well, I mean, three aspects to data. One, I think data combined with technology is allowing us to understand our own business better and make it more efficient. It enables us to understand customers better. The more data we collect about them, the more accurately we can assess their risk profile and therefore avoid mis-selling or misallocation of resources. And I think it enables us to tailor products more on a more personalized basis to cohorts of individuals and articulate why those products are suitable for those cohorts. I mean, I think that there are risks in machine learning. I think, as John said, I think it's done a fantastic job in the banking industry in terms of scenario analysis, stress testing, and so on, because it enables us to crunch huge amounts of data in a way that humans could never do in any reasonable period of time. The risk we all have to guard against is if everyone uses the same kind of algorithms, you end up with crowded trades and everybody moving in and out at the same time, and you know that is systemically very, very dangerous. I mean, I think again back to the use of technology. I mean, the more people have in their hands a mobile computer that they interact with their financial services provider, whether it's asset management or banking, and they all press the button go at the same time to move their deposit or to divest from their mutual funds. I mean, you would get an avalanche of a run on, whether it's an asset manager or a bank, beyond that which you've ever seen before, because it's easy to do. You don't have to walk down and talk to someone and have a face-to-face conversation. In terms of people, I think the interaction with customers is going to be more and more digital going forward. So a higher proportion of our staff are going to be data scientists, data managers, because they're effectively going to create the products and the services that enable us to reach customers well, and it's going to be the interaction is going to be enabled by technology as opposed to technology being the back end to a human intervention. So it will be different. There'll be fewer people in the face-to-face and the ops area, but there'll be more sophisticated, more technology-driven.
I think we have time for one quick question from the audience. A topic that may come up in every single panel over the next couple of days is sustainability, ESG issues. I wanted to pose it, John, to you as, how do you think about sustainability as you run the business of Citi? And so not just as an asset class, but as you think about kind of everything that Citi's doing, how does that factor in, and how are you changing behavior?
Well, it's several things. One is we have an internal goal of Citi as a proper about renewable energy, for example, and we commit We have committed to be 100% renewable energy by the end of 2020. That's one sort of tangible, concrete thing. A second thing is to set goals for sustainable finance that you provide to third parties. And there we had a 10-year, $100 billion goal that we got almost halfway through in less than 5 years. We've changed the metrics some to make it more challenging, and that continues. Citi is the biggest affordable housing provider in the United States for the 9th straight year. So it's a big place that we put a lot of money. And then, of course, we've been a longtime supporter of the Equator Principles and things related to that as we do financing on a go-forward basis. So this is a huge area, and it's growing, as you've heard from the other panels. We get it all the time, and each year in our investor cycle, our annual meeting cycle, we hear more from investors, and we look for new and different ways to do things as we go forward. But those are just some examples.
Douglas, what about you? You're probably one of those investors that's pushing him on his sustainability.
That's right.
Yeah, I mean, well, it's embedded in what we do. But I think one of the things I'd add to what John said, which I agree with, is that it's increasingly a dialogue with our employees and prospective employees. People want to work for an organization that they believe has got ESG embedded within it, in what it does itself and how it interacts through its supply chain customers, and certainly in our case in terms of how we invest money. I think there's, on our industry, asset management industry, I think there's an additional responsibility to contribute to the education, because it's really easy to say we shouldn't do this anymore. But then what does anymore mean over what time scale? And we're in a world of transition, not a world of sort of tomorrow we can stop and do something completely different. It's a transition. And helping people understand that transition is going to take longer than we might want, and every company and every country will move at a different pace depending on where they start from. And what we should try and work towards is making it better, because you're not going to make it perfect in one go.
If I could just add to that.
Yeah.
I mean, you mentioned employees, because it's not just investors, it's not just shareholders, it's your employees too.
Right.
And so when issues have come up around immigration, for example, and restrictions, Citi's maybe the most global bank in the world. We're in 100 different countries. It was hugely important for the company to put its best foot forward about the importance of immigration and how we did it. And likewise, we had employees that were involved in a number of the mass shootings in the United States, and it led to some of the things that we have done in the gun area, hugely controversial, but nevertheless, that was one set of stakeholders that we felt it was very important to respond to. And I think, we think that was the right thing to do.
And your employee population is the size of a small city, so that's obviously an important constituent of yours.
People, that's exactly right. So.
Well, I want to be cognizant of time. If you'll join me in thanking these panelists again, I think it's been a great morning, and thank you for your various and diverse views.
Thank you.